Welcome to the International Accounting Channel. Remember to subscribe to the channel, like, share your opinion. Together with us to answer multiple choice questions about international accounting. Now, let's get started. On October 4, an MIT company supplied an order to a customer with a total value of $3,000. The customer paid immediately. The entry to record MIT's sales revenue collection transaction. A. Debit cash account $3,000 per credit revenue account $3,000. B. Debit revenue account $3,000 per credit cash account $3,000. C. Debit account receivable from customers $3,000 per credit revenue account $3,000. D. Debit revenue account $3,000 per credit account receivable from customers $3,000. Debit cash account $3,000 per credit revenue account $3,000. HTD company purchased inventory worth $340,000. The company paid in cash $140,000. The remaining amount has not been paid in arrears under the payment terms 2/15 and 60. Knowing that the above transaction occurred on September 5, 200 According to the net price method, the value of inventory recorded in the accounting books is A. $340,000, B. $140,000, C. $336,000, D. $200,000. $336,000. On February 6, 2014, the company sold a shipment worth $2,000 to a customer using the sales method with the right to return the goods. On June 20, 2014, the customer returned a portion of the shipment worth $500. The deadline for the right to return the goods is June 30, 2015. If the company records revenue at the time of delivery, the revenue from returned goods will be recorded on A. February 6, 2014. B. June 30, 2014. C. The end date of the accounting period of February 2014. D. June 20, 2014. June 20, 2014. When selling goods directly to customers, if using the periodic inventory method in inventory management, the cost of goods sold indicator will be recorded when A. Delivering goods to customers. B. Customers pay. C. End of accounting period. D. Any time. End of accounting period. On January 24, an MTJ company supplied an order to a customer with a total value of $2,900 under the direct consumption method. The customer paid immediately. The accounting entry to record MTJ's revenue. A. Debit cash account $2,900 per credit revenue account $2,900. B. Debit revenue account $2,900 per credit cash account $2,900. C. Debit accounts receivable from customers $2,900 per credit revenue account $2,900. D. Debit revenue account $2,900 per credit accounts receivable from customers $2,900. Debit cash account $2,900 per credit revenue account $2,900. MTJ Company manages inventory using the perpetual inventory method. On January 31, 2014, according to the inventory results, the value of inventory goods, $123,700. While the end-of-month balance of the merchandise account is $122,900. The accountant makes the following adjustments. A debit cost of goods sold account $800 per credit merchandise account $800. B. Debit merchandise account $800 per credit merchandise account $800. C. Debit cost of goods sold account $123,700 per credit merchandise account $123,700. D. Debit merchandise account $123,700 per credit merchandise account $123,700. Debit cost of goods sold account $800 per credit merchandise account $800. On September 27, MTJ Company transferred 1,000 products to AB Company for a short-term loan of $105,000 for a term of 2 months, with an interest rate of 2% per month, and a storage cost of $300 per month. On November 27, MTJ paid AB and received the goods. MTJ's accountant recorded a debit short-term loan account, $105,000, debit interest expense account, $2,100 per credit cash account, $107,100. B. Debit short-term loan account, $105,000 per credit cash account, $105,000. C. Debit short-term loan account, $107,700 per credit cash account, $107,700. D. Debit short-term loan account, $105,000, debit interest expense account, $2,100 USD, debit storage expense account, $600 per credit cash account, $107,700. E. Debit short-term loan account, $105,000, debit interest expense account, $2,100 USD, debit storage expense account, $600 per credit cash account, $107,700. On January 15, 2014, MTJ Company shipped goods to the agent for sale. On January 15, 2014, the agent received the goods and sold the above goods on February 7, 2014. On February 15, 2014, MTJ received the agent's sales report. According to the regular reporting method, MTJ's accountant will record the cost of goods sold on A. January 15, 2014. B. February 7, 2014. C. February 15, 2014. D. February 28, 2014. February 15, 2014. On January 5, 2014, the company sold a shipment of goods worth $3,000 to a customer using the return method. The company recorded estimated revenue on January 5 as $2,500. On March 31, 2014, when the return period expired, the company totaled the actual amount of goods returned by customers for the above shipment as $700. Therefore, the accountant will have to adjust the revenue from returned goods. A. Increase $200. B. Increase $700. C. Decrease $200. D. Decrease $700. A. Increase $200. On January 2, 2014, MTJ sold a shipment of goods worth $1,000 to AB under a purchase with right of return. On January 15, 2014, AB returned $300 of the total value of the goods purchased. How much sales revenue would MTJ recognize if it recognized the revenue at the end of the return period? A. $1,000. B. $300. C. $700. D. $1,300. D. $700. Thank you for watching our channel. See you again in the next video.